In the final stretch of 2025, the world's most conservative institutions made a move that contradicts what most people think modern money is supposed to be. Central banks ended the year with 230 tons of net gold buying in the fourth quarter, pushing full-year official purchases to 863 tons. That is not a symbolic gesture. It is a reserve strategy shift measured in vault space, transport schedules, and policy meetings, and it happened quietly, the same way the biggest changes always happen. They said this could never happen again in a world of floating exchange rates, instant settlement, and deep bond markets. They said gold was a relic, something you keep in a museum or in a history book. They said central banks would be net sellers forever because sophisticated finance made the old constraints obsolete. Yet the data says the opposite. Not months from now, not weeks from now. In a single reporting cycle, the official sector closed the year by accelerating again. And the part that changes everything is what that acceleration implies about trust. Because when a household buys gold, it is a preference. When a hedge fund buys gold, it is a trade. When a central bank buys gold, it is a statement about the system itself. It is a quiet vote on credibility. Those votes are being cast before the public conversation catches up. Institutions feel stress lines long before most people can see them. The public usually notices only after the cracks appear on the surface. Welcome to Channel Name, where we take the numbers institutions cannot hide and translate them into the story the market is actually telling. If you like analysis that feels like listening to a calm observer who has seen a few cycles, you are in the right place. And if you are watching right now, drop a comment with where you are tuning in from, because this is a global story and the signals look different depending on where you stand. Now let's talk about what actually happened with forensic detail. On January 29th, 2026, the World Gold Council summarized the latest demand data, and the picture was unmistakable. Central banks, as a group, bought 863 tons of gold in 2025. They did not drift lower into the close. They stepped on the accelerator 230 tons in Q4, which was 6% higher than Q3. In Q3, net buying was around 220 tons, and that was 28% higher than Q2. So this was not a single spike. It was a sequence. Q2 softer, Q3 stronger, Q4 stronger again. One buyer alone tells you this is not noise. The National Bank of Poland added 102 tons in 2025. A single country adding over 100 tons in a year is not a headline-chasing impulse. It is a national portfolio decision. It signals a preference for an asset with no counterparty risk, an asset that does not depend on the solvency, politics, or payment systems of another state. Poland was not acting in isolation either. The year showed multiple official buyers accumulating in steady increments, often during moments when the public focus was somewhere else. Here's where it gets interesting. In some comparisons, official buying has been below the most explosive recent pace that topped 1,000 tons. But that framing misses the real message, because markets did not behave like demand was fading. Total gold demand in 2025 was above 5,000 tons, and the value of that demand reached roughly $555 billion, even with official buying below the absolute peak. The combined bid across official institutions and private demand was strong enough to reset the tone of the market. That contradiction is your entry point. The story is not just how many tons were bought. It is who is buying, why they are buying, and what else is moving at the same time. It is about a pattern that appears whenever confidence in core promises begins to wobble. And to see it clearly, you have to put today next to history, not just next to last quarter. In 1971, the monetary backbone of the post-war world broke. The dollar's link to gold was severed, and what followed was not an instant collapse, but a decade of inflation shocks, currency volatility, and a repricing of what risk-free really meant. Gold did not rise only because people felt emotional. Gold rose because the rules of settlement and trust had changed, and the old yardsticks no longer measured reality. In 1998, a different kind of stress surfaced. It was not primarily inflation. It was leverage, liquidity, and the belief that sophisticated models could tame tail risk. When that belief cracked, capital rushed toward the most liquid and universally recognized collateral, and policymakers responded in ways that reminded markets of a timeless lesson. In crisis, the rules can be rewritten quickly, and the winners are those closest to the plumbing. In 2008, the pattern became undeniable. The financial system's most complex instruments were exposed as fragile, and what followed was a world where central banks expanded balance sheets on a scale that once would have been considered impossible. A new regime emerged, intervention as a feature, not an exception. In that regime, trust becomes something that can be priced, hedged, and defended. Gold becomes a barometer of the market's faith and the promises sitting underneath everything else. Now, in the current cycle, the rhyme is unmistakable. Debt burdens are heavy. Inflation shocks have returned a kind of uncertainty many institutions had not priced for a generation. Geopolitical risk has altered trade routes, payment preferences, and the perceived neutrality of reserve assets. Sanctions and restrictions have reminded reserve managers that access to assets is not always purely technical. It can become conditional. So when central banks buy gold in size, it is not nostalgia. It is risk management aimed at autonomy. This is the part most people miss. Gold is not competing with stocks for excitement. Gold is competing with reserves. It is competing with sovereign paper treated as pristine collateral. It is competing with the belief that a promise from a powerful issuer is always as good as cash, everywhere, all the time. When you frame it like that, the official movement becomes easier to read. It is a shift in what counts as the ultimate settlement asset. Let's name the players and their roles. On the official side, you have central banks accumulating physical gold as a reserve asset. On the market side, you have bullion banks providing liquidity, exchanges setting contract terms, and vault operators custodying metal on behalf of institutions. Gold trades in two overlapping realities. There's the paper reality of futures, swaps, and unallocated accounts, where enormous notional volume changes hands with minimal physical movement. And there is the physical reality, where bars move through refiners, logistics networks, and vaults into long-term holdings. Most of the time, those two realities align well enough that nobody cares. Price discovery happens in liquid venues. Hedgers manage exposure. Investors get their allocation. But when the marginal buyer is a central bank, the physical reality matters more because banks tend to remove metal from the trading float. They vault it. They hold it. They do not flip it in and out for quarterly performance. That changes the texture of the market. Liquidity can still look abundant on screens while the physical pool quietly tightens behind the scenes. That sets up the dislocation. When those signals diverge, the system has to resolve the gap. Paper claims remain stable only when they can be rolled, netted, or settled with confidence. If trust shifts, settlement preference changes. And once settlement preference changes, price becomes the messenger. To understand why this matters now, notice the environment these purchases are happening inside. The global financial system runs on confidence in two things at once: that sovereign debt issued by a small set of countries will always be liquid, that the payment rails connected to those countries will remain open and predictable. For decades, that assumption felt safe. Government bonds were not just assets. They were the collateral that lubricated leverage, repo, and liquidity. Reserve currencies were not just convenient. They were the default settlement language of global trade. But recent years have forced reserve managers to think about a different category of risk: access risk. Not whether an asset is good on paper, but whether it is usable in every scenario. When a reserve portfolio is designed only for the sunny day, it can fail on the stormy day. Gold is held precisely because it does not require permission. It is not a promise to pay. It is payment, and it can exist outside the rails. Now look at the other side of the ledger. While central banks accumulate, governments keep issuing debt, and public balance sheets expand, contract, then expand again. Markets debate the next rate move, the next inflation reading, the next headline. Most of that debate is loud, and most of it changes weekly. Central bank reserve decisions are the opposite. They are slow, procedural, and remarkably revealing. They tell you what the people closest to the monetary core want to own when they imagine the full range of outcomes, including the outcomes most people prefer not to discuss. This is also why gold can rise even when yields look attractive. The textbook story says a non-yielding asset should struggle when cash yields something. Yet gold can compete when the demand is not about yield. It is about certainty. A yield is a return you receive if the promise is kept. Gold is what you hold when you prefer an asset that does not require a promise at all. Another dislocation sits in plain sight. On some days, gold trades like a liquid financial asset, moving with the dollar and rates. On other days, it trades like a strategic reserve asset, shrugging off short-term macro noise and responding to structural demand. That split personality confuses observers because they assume there is one true driver. In reality, there are multiple buyers with different clocks. Traders think in hours. Investors think in quarters. Central banks think in decades. When those clocks overlap, moves can look sudden. A quarter ends, official buying prints strong, and simultaneously a wave of investors reallocates through ETFs and other vehicles, because performance turns the story into something that can no longer be ignored. ETFs matter because they can act as a bridge between institutional capital and physical demand. They allow large pools of money to express a view quickly. And in many structures, that view is matched by higher vaulted holdings behind the scenes. That can tighten availability further, especially when official buyers are already removing metal from circulation. Do not overlook psychology, either. Gold is one of the few assets that carries memory. People remember what it did during inflation shocks, during crises, during currency stress. That memory sits in portfolios like a dormant circuit. When conditions feel stable, the circuit is quiet. When conditions feel uncertain, the circuit lights up. Central banks buying hundreds of tons is like flipping that circuit from standby to active across the system, even for investors who do not consciously follow the quarterly data. Now add the second engine, private investment flows. Central bank buying is typically steady and strategic. Investment buying can be sudden and reflexive. When investment vehicles ramp up at the same time, the official sector continues to accumulate, the market can shift from quiet strength to visible momentum quickly. This is why you can see a year where central banks are still buying heavily and investors suddenly care again in the same window. Those two forces behave differently, but together they can create a powerful pressure that shifts narratives and pricing at the same time. And this is where the paper versus physical question stops being a slogan and becomes a mechanism. If a large share of trading activity is paper, the system functions smoothly as long as most participants are content with financial exposure rather than delivery. But if a larger group begins insisting on physical allocation, or if official buyers keep pulling metal into long-term holdings, the structure can feel strain. The response is often subtle at first: wider spreads, higher local premiums, and more sensitivity to inventory and logistics constraints. You do not need to memorize market microstructure to grasp this. Imagine a theater that sells digital tickets. Most people are happy showing a QR code at the door. The system is efficient because it assumes a predictable flow and a high level of trust in the process. Now imagine a growing share of customers insists on printed tickets with assigned seats, verified manually, because they no longer trust the digital system. The theater might still look calm online, but at the entrance, the process slows, lines form, and the real bottleneck appears where settlement meets reality. This is also why geography matters. A significant portion of official buying has come from institutions outside the traditional Western Reserve centers. That changes the map of marginal demand. It also changes which narratives dominate. Some narratives frame gold primarily through the lens of interest rates and inflation. Other narratives frame gold through the lens of autonomy, sanctions risk, and reserve security. When those frames collide, you get a market that moves in ways that confuse observers who insist on a single driver. Now let's put the evidence on the table, because this is not opinion. Q3 2025 net central bank buying, around 220 tons, 28% higher than Q2. Q4 2025 net buying, 230 tons, 6% higher than Q3. Full year 2025 net buying, 863 tons. Poland's central bank additions, 102 tons. Total 2025 gold demand above 5,000 tons, with total demand value around $555 billion. Those numbers describe a market being re-anchored by conservative actors and reinforced by broad demand. And because these actors move slowly, their actions are often dismissed as gradual. But gradual in reserves can be seismic in effect because reserve portfolios are gigantic and sticky. When a reserve manager shifts even a small percentage point, the absolute size is enormous. Think of a supertanker changing course. The turn is not sharp. It is not dramatic in the moment, but the momentum is massive. Once the ship commits to a new heading, the ocean looks different for everything around it. So how is this executed in practice? Central banks do not typically buy gold the way a retail buyer does. They use established bullion channels, often seeking minimal disruption. They may buy in tranches, use intermediaries, and integrate purchases into reserve rebalancing schedules. The objective is not to time a weekly chart. The objective is to change the reserve mix over years while maintaining liquidity, custody security, and political flexibility. Meanwhile, the publicly quoted price is heavily influenced by derivatives, hedging, and the behavior of liquidity providers. Physical metal moves through a chain: miners, refiners, logistics, vaults, and end holders. When physical demand rises, the system can respond by drawing down inventories, increasing recycling flow, and redirecting supply across regions. If the physical pull persists, paper markets can still look liquid until suddenly they don't. That is when dislocations become visible, and when the market is forced to reconcile screens with settlement. This is why the most important signal is not the loudest. The most important signal is who is quietly choosing the asset with the least dependency on other people's promises. Gold is autonomy in a bar. It has no issuer. It has no default risk. It has no policy committee. It does not depend on a payment system to remain what it is. That makes it uniquely attractive when the global environment feels less predictable. You do not need a conspiracy to get coordinated outcomes when incentives align. If multiple central banks look at the same world and see rising access risk, high debt burdens, and renewed inflation uncertainty, they can independently arrive at similar conclusions. And the timing can cluster. The flows can reinforce. The market can interpret it as a trend. That is not shadowy. That is institutional logic. That is also why the World Gold Council's January 29, 2026 update mattered. It was a timestamp on a trend that has been building, and it confirmed that the year did not end with exhaustion. It ended with continued accumulation. If you want to understand markets, respect what institutions do at the margin, not what they say in speeches. Their actions are the truth, and the truth usually arrives in the data before it arrives in the headlines. So what does this mean going forward, without pretending to know the future? Historically, when official buying is sustained at high levels and investment demand turns higher, you tend to see one of three broad outcomes. In a conservative scenario, the system absorbs the flows and gold grinds higher in real terms without a dramatic break. The move is persistent, driven by steady accumulation and periodic bursts of investor attention. The key signals in that scenario are contained to currency volatility and stable real rates because they reduce the need for panic and allow a slow repricing. In a moderate scenario, the dislocation between paper convenience and physical preference becomes more visible. That can show up as higher regional premiums, more sensitivity to geopolitical events, and larger day-to-day swings as liquidity providers widen spreads. In that world, gold becomes less about an investment theme and more about a settlement preference. The signals to watch are stress in the plumbing, sudden changes in market depth, unusual behavior around roll periods, and persistent tightness that refuses to fade. In an aggressive scenario, a catalyst accelerates the trust repricing. That could be a policy shock, an inflation resurgence, a debt scare, or a geopolitical event that changes reserve behavior quickly. The signals there usually involve changes in the behavior of conservative institutions, more central banks joining the buying cohort, and fewer willing sellers in the traditional channels. So what should be watched? Not as instruction, but as an information set. First, the quarterly official data. Does net buying remain near the 200-plus ton pace per quarter, or does it drop meaningfully? Second, the identity of the largest buyers. Do the same institutions keep accumulating, or do new names appear? Third, the behavior of investment vehicles, because they can magnify moves quickly when flows turn. Fourth, the macro backdrop, debt servicing costs, inflation expectations, currency volatility, and the subtle signals that confidence is being repriced. Now we arrive at the divide. There are those who see these numbers and dismiss them as background, and there are those who understand that reserve shifts are not background. They are the foundation. This is not about being smarter. It is about watching the signals that matter most. The public tends to focus on what is loud: headlines, commentary, daily price candles. Institutions focus on what is structural: settlement, collateral, and trust. That is why the information gap becomes a wealth gap over time. Central banks move first. They move quietly in quarterly increments. Then asset managers move because performance, risk constraints, and flows demand it. Then the public notices, usually after the price has already repriced the obvious. That sequence is not new. It is as old as markets. The only thing that changes is the instrument and the excuse. So when you hear central bank gold buying accelerates, do not treat it as trivia. Treat it as a diagnostic. 863 tons in 2025 is the system telling you something. Q4 at 230 tons is the system telling you it was not done at year end. Poland adding 102 tons is one institution telling you that diversification is no longer theoretical. And record total demand value around $555 billion tells you the bid is not isolated. Gold does not need a story to exist. It does not need earnings. It does not need an issuer. Its story is simply that it sits outside the system. And when more of the system chooses to hold something outside itself, that is a signal about the system's self-confidence. Watch the quarterly prints, because that is where the real story keeps speaking. This is Channel Name, where we decode what matters before it becomes headlines. If this connected dots you had not seen, you know what to do. Because the question is not whether patterns unfold. The question is whether you recognize the pattern while it was still just data.